Hello, and welcome to another episode of Financial Clarity Live. Today, we're going to zero in on understanding gross margin. We're going to be led by our esteemed CFO, my business partner, Phil Matthew. Thanks for joining us, as well as our awesome financial analyst, Augie Manzella. Thank you for joining. Okay, so today we're going to dive right into gross margin and why it's critical, especially for technology businesses that are counting on growth to hit their goals. So as we look at gross margin, which we're indicating is really the true indicator of profitability, Phil, for anyone out here who's just a rookie in this topic, which is okay, we invite rookies as well as experts to the table. Can you just help them think through this in a simple, let's call it third grade math format?
Yeah, absolutely. So there's the easiest way that I was taught many moons ago how to think about this is your cost of goods sold. Right, you've got different ways you spend money. You've got your fixed costs and you've got your variable costs. So the variable costs that change as your revenue changes, those are your cost of goods sold most of the time, right? And then the kind of the first rule of thumb is if I make an extra incremental dollar of revenue, am I going to have to spend X number of dollars to go get that revenue? And the answer is yes. Then you're talking about cost of goods sold, and if the answer is no, then we're probably talking about more of an OpEx type of
item. Okay, got it. So the math is right up here. Revenue minus COGS divided by revenue times 100. That's your ability to generate profit while covering your cost. Higher gross margin gives you more room for things like marketing and R&D. Lower gross margin means it's going to be a tougher climb up the mountain and more susceptible to competition and other I will say competitive forces that might be out there. I guess, Augie, how have you seen that a business can track their gross margin effectively over time? What are you seeing?
In a nutshell, the forecasting process, just making sure that all your actuals are up to date. Make sure that you're, checking the trends against each other. When you're looking at the next forecast, you want to see, did you hit your projections on the last one? What trend does it look like it's moving in? And basically, being aware of what the normal numbers in your industry are and making sure you're within that reasonable realm.
Okay, sounds good. All right, so we talked about how to calculate this at like a mathematical level, but now we're talking about a real business. Today, we're going to be focusing in on a SaaS technology business. So anything that we're talking about example-wise is that. So as we look at what might be the COGS or cost of goods sold for that business, we're looking at hosting fees for cloud, software licensing fees, obviously the support and maintenance that's going to go up and down in a variable sense with the level of seats that are sold, the level of support that's needed. But I guess many business owners look at revenue, but not at COGS. Phil, why is tracking COGS just as important?
I would probably argue that getting this right is one of the most important things because it's going to give you a lot of the back of the envelope math you need to make good decisions, right? So what's left after you make your revenue and then you spend your COGS is your gross margin dollars. And those are the dollars you have left to, operate your business, to pay your people, to invest back in the business, to pay your shareholders, to pay your debts, whatever it may be. So if you don't know for every incremental revenue dollar you make, how much you have left over to service those things, you're doing yourself a huge disadvantage. I think, getting this bucketization right. And then to Augie's earlier point, to be able to analyze this property, having the right level, and, we'll kind of touch on this across whatever topic we talk about, but having the right level of granularity in your accounting system, in your forecasting tools, and all of your source systems to be able to capture information in a way that allows you to analyze it is imperative. So if you need to understand your industry, right, and so, for a cloud-based business, these are definitely going to be three buckets we have under that headline cost of goods sold bucket that we're going to track towards. Same thing goes for revenue, right? The more detailed information you're able to put in, you're going to get better information on the way out, right? So if you want to be able to track your gross margin, not just for the whole business, but at the product level or at the line of business level, that's going to take a level of architecture and thinking about how you digest all of your financial information and then present it to the executive team, to leadership team, how you structure your accounting system to be able to do this analysis that Augie was referring to.
All right, I'm going to talk about some mistakes I've seen from the skeletons of the entrepreneurial highway. But before that, Augie, what common mistakes do you see businesses make when calculating gross margin? Oh, I'm muted, bud.
Sorry about that. Trying to cut down on the echo. I would say the biggest one would be mixing up operating expenses with COGS and having things not show up on the balance sheet the right way as a result. Also, if you're not keeping up with any price changes for your supply, for goods or whatever it costs you to do business, if you're paying more and you're not accounting for that, that's a big pitfall.
Yeah, I've
As
seen
well
this.
as there's occasionally hidden costs that get accounted for in the wrong spot, and those go missing as well.
Makes a ton of sense. And one thing, anyone out there listening who kind of accepted the defaults in QuickBooks Online as they got things set up. One thing I've seen a ton in businesses that'll get to 10, 15, $20 million in revenue. And just the way that QuickBooks set it up originally, it kind of didn't create the cost of goods sold. And so they just naturally dump everything into OpEx, and they're kind of kidding themselves about what their cost to produce is. And then you take a business that maybe has a long sales cycle, and maybe they can negotiate decent terms with their vendors, but that is tricking them into thinking they're more profitable than they are, and then they expand. And we know that gross margin and profitability, true profitability over time, if you get bigger, it makes good, it makes good greater, and it makes bad worse. So it's really important, as you said, to set this up right and get it right. And if you're making these mistakes, there's time to fix them. All right, so let's jump into gross margin and its impact on a business. Here we go, looking at this SaaS company with 10 million in revenue. And I guess, Phil, how can a CFO leverage the gross margin to make, smarter pricing decisions when it comes to this SaaS business, as an example?
Yeah, I think that's a good question, Josh. And if you're not in the SaaS business and you're looking at this, this insanely high gross margin, that's because these types of businesses, that's the way that, that's the allure, and that's why you see big tech, getting the valuations they get, because they, generally speaking, are able to achieve huge economies of scale and ultimately have very high gross margins to the tune of 70, 80%. Right. So this example, while, if you're sitting there as a construction guy or, in a different industry, it might seem a little ridiculous, but kind of this really applies across the board. But in this particular example, you would expect as an owner of business to have an incredibly high gross margin, and for every incremental revenue dollar you make, to be able to push most of that, down to the bottom line. So what you're seeing here, and kind of what we alluded to earlier, is that cost of goods sold, that 20% of the revenue, leaving you with the 80% margin, is then broken down by the sub pieces that make it up, right? So what you saw on the slide previously, and this is where we're going to look to see what the trends are. To Augie's point earlier, we've seen it with clients in a variety of different industries that weren't tracking their gross margins properly, weren't keeping up with the price increases that they were keeping. And, it's a two-part equation. If you don't pass those along to your clients, they're going to dilute your margins. So being able to balance all these things and see where these cost increases are coming from, and this level of granularity gives us that ability, right? Do we know, is it going to be our hosting fees versus our licensing fees, right? Is it going to take us to cost more to support clients? A lot of times, or individual hours based, and we go even deeper, right? How many support hours are needed? How many do we expect to need if we grow revenue? And managing all of these different pieces while we're incredibly profitable, it enables us to stay that way and understand, if we are seeing increases with these various pieces, A, do we find new vendors, try to drive costs down, or B, do we pass those price increases along to customers and maintain our margins, right? And that's going to be decisions that the whole executive team needs to make, and it's the finance team's job to present this information, present the data, and be able to say, hey, we were making 82% gross profit last year, we're down to 78%. Do we know why? And ultimately, what are we doing about it? Are we willing to accept that? And for a variety of reasons, the answer may be yes or maybe not. But, kind of in a nutshell, that's what we're doing during this exercise, to be able to say, all right, let's look at this stuff, week in, week out, month in, month out, depending on the audience and the level of granularity, to understand what's going on, so that when we go to scale and talk about future plans, we understand what we're able to do from terms of debt service and all that good stuff, because we'll understand what cash we're going to generate based on a clear understanding of what it costs to generate incremental revenue.
Yeah, absolutely. And, I think there is a lot of times, especially in the technology world, kind of a, I don't care, just run faster mentality. And I think like number one, we see here is the number one cost of goods sold is cloud hosting fees. And it says servers, cloud infrastructure, data storage. That may be kind of ambiguous, like just kind of this thing that happens, over there for the ownership level. But if that price were to double, and you were to find out, well, that really had to do with the price of the commodity of energy, and that has to do with demand from AI, electric vehicles, weather variations, et cetera, that would greatly impact this business, especially if they're highly levered and investing, all chips on the table to hit some growth target because they need to get to their next round of a raise. So, that's just an example. But Augie, what are you seeing are some strategies for reducing COGS without harming product quality?
There's a few first line items that I would address. Mainly, you can always try to negotiate better terms with vendors that you use, especially if you've been in business with them for a decent amount of time. You'd be amazed what kind of leverage you have with them. Also, I would go through your infrastructure and make sure you don't have any redundant software packages or subscriptions that aren't getting used, things that you could just minimize immediately. And then most recently, there's more and more opportunities to use automation and AI and really increase your productivity per time unit spent.
Okay. All right, so, got a cool little visual here of like, what does this mean? As we think about this business and it's working towards, enhancing its profitability, I guess, Phil, how should the business owner determine if their gross margin is good for the industry? I mean, 80 to 90% is always good. It feels good, but like, is it good enough? Is it good enough to compete? Is it good enough to remain in business? Should they look for an exit? Should they look to acquire somebody with higher margins that they can create a higher weighted average? Like, how do you go through that conversation with the business owner?
So, I think it's going to be on a case by case basis, right? But I know the first measure that I would look at, and kind of understanding what the benchmark for your industry is and your geography, right? I'm looking at a survey now from esteemed NYU professors. So, got 35 different industries and what the average gross margin in the US reportable is. So you can get really good granular data for what it should be. So, if you're above or below the industry average is a good benchmarking and a good point of reference to kind of say to yourself, well, if I'm above, by calling into question, am I doing this right? Do I have the right cost of goods sold, or am I not thinking about this the right way, or am I just super profitable for my industry, or vice versa? If I'm lagging, what can I do to be better? And ultimately, at the end of the day, right, it's what you have to run you have a burn rate, the amount of money you're spending every month, no matter what happens. So your gross margin is going to tell you, right, how much revenue you need to break even. And then it becomes the management team's job to determine, right, from a viability and feasibility, how much above that that burn are we generating? Is that going to make our investors happy? So the capital structure of the business means everything to dictate the answer to that question. As you alluded to earlier, there's growth targets baked into a lot of these Series B, Series C companies where what is good for one may not be good for the other, and it's all a matter of context to the various stakeholders of that business, right? So what we do, regardless of what that landscape looks like, is lay the information out in such a way that we can make these objective data driven decisions that will highlight the areas that are looking anomalous relative to expectations, the benchmarks, whatever that may be. And that oftentimes becomes the focal point of the conversation to, drive strategic decisions and to drive, management decisions to, chart the course forward.
All right, Augie, can you fire up that mic and give an example of a business that has improved its gross margin successfully that you've been a part of?
Sure. Recently, we worked with an e-commerce company who was, I guess, their shipping process was sort of legacy from when, the bootstrap days of that particular company. And so they found some really quick, easy ways to optimize their shipping logistics and reduce COGS that way.
Okay. Yeah. No, I can think of another example similar to that. All right. Great. So, looking here at the gross margins impact on business strategy, we talked on revenue setting in a different one of these episodes, but gross margin a lot of times informs pricing strategy. It tells you how much gunpowder you've got in the tank, if you will. So, I guess, Phil, if a business owner only had time to focus on maybe one aspect of gross margin improvement, you can give us a couple if you want, but like, what should it be, or how do they go about making that decision?
Yeah, I think again, it's going to be very, specific in terms of, the business itself, but ultimately it's a two-part equation, right? You either cut costs or you raise prices to maintain your margins. And, you can only do either one to a certain degree, right? So as the CFO's job, it's really laying out the possible range of possibilities, right? You can increase the price, also increase your COGS, right? Try to drive your COGS down. Right? You can do this equation a bunch of different ways, but ultimately it's our job to present those range of outcomes and then talk about the risks associated with all of them, right? If you increase your prices too much, you're going to lose your customers, right? If you try to drive costs down too much, you're going to lose good people. You're going to get less than high quality inputs for your products. So it's really imperative to understand how these things bounce off of each other, all within the context of what you need to do to generate cash to stay afloat, right? So it's kind of presenting this equation to kind of if this then that, where hey, if we increase prices, we're taking these risks, but we will be able to maintain our margins, which will then allow us to continue to invest in the business or whatever it may be. So that's the, I guess, roundabout answer to your question.
All right, and Augie, when we're talking about, it's not just humans, there's technology involved in all of these steps. What tools or software do you recommend for tracking and optimizing gross margin?
I think there's a number of good platforms that, say you wanted to just have a simplified version, anyone could give you sort of some input, things like QuickBooks, Giraffe, Monday. But I think when the numbers really start to sing is when you orchestrate all those together. And that's what we do with our process is, we're feeding data back and forth between a number of platforms, and that's giving us a much more robust and granular look at the actual numbers.
Great. So, just kind of hitting this again, industry benchmarks and comparisons, for this industry, we're saying 70 to 90% gross margins. Phil, you're saying it's out there. All you have to do is search to figure out what your industry standards are. You can identify improvements, and then with that's kind of step 1 and 2. But now you've got to make decisions, right? This is where a CFO comes in to guide those decisions. The analyst team supports that by pulling together disparate sets of data. And, ultimately, not every one of those decisions is going to be perfect, but by this process of measuring, managing, and improving it week over week, month over month, you can see, small incremental benefits that also, if you're leveraging the business for growth, can become really large and ultimately be your impact maker of, do you get to raise money one less time and retain your equity further into the future? Do you end up having a multiple that's 2 or 4x larger than it would have been on your exit? Can you distribute cash to the business partners quarterly instead of annually? These are all the outcomes that can come from this. We talked about the annual actionable takeaways and what to do and how to do that, reviewing the margin and the COGS on a consistent basis, evaluating pricing, optimizing margins, aligning the team around these goals, because ultimately it's a team that makes most businesses work, not just one or two people. And now we've got a couple questions from folks out there. So we've got one from Sarah Carter. She's CEO of Growth Tech, Saas company. Says her company's gross margin is strong, but our profit's still low. What should I look at next? And I think based on her question, she's looking at you, Phil.
Yeah, and I think it's one of those where, there's the a little bit the next conversation, I guess, behind the one we had today, where if you have really strong gross margins, but nothing's left in the bottom line, then you got to take a good hard look at your OpEx and your fixed costs, because that's the only other place to drive that mathematical equation, right? That's where you're either spending way too much, you're definitely spending way too much money somewhere, because at these really high margins, if you're not you know carrying that down to your operating margin, and we can have a whole other episode on EBITDA margins, opera margins, and net margins, and pre-tax margins, all that good stuff. But I think that we start with gross margin. That's the mother of all margins, and it's going to be the way you frame that question gives me a really easy answer to it, which is you got to look at your OpEx relative to your fixed costs.
She's replying back. Yep, you're right. It's R&D. I've been funding my next company with our profit margin. That's what she said. All right, and let's talk about the next question up. David Lopez, he's a founder of Elite Manufacturing. He says, we have slim margins due to high raw material costs that seem to be continuing to go up. Should we increase prices or cut costs? I guess both of you guys maybe take this and bounce it around.
Well, interestingly enough, since we're talking about SaaS services in this episode, I'd like to point out a couple companies like Netflix and Spotify who have seemingly justified continual price raises, and that's one of the reasons it's really important to be aware of specific industry trends. You don't want to be leaving money on the table if the market is willing to bear more.
Okay. Phil, you got anything else on that?
Yeah, but I guess what to piggyback on what I'll get saying, right, is like, unless it's a strategic advantage to be less profitable than your competitors, you better be damn sure that you need to be keeping up with their pricing, because if you're not taking their market share by having lower prices than them, then something's missing in the equation, right? That would be the only reason you wouldn't pass those prices along to the customers, where you could, in theory, absorb them, still operate the business, and then take away market share from your competitors, and therefore have a bigger, a larger market share with a slightly smaller margin, but still at the end of the day generating more cash, right? But and these are the mathematical equations you need to lay out for yourself to make these decisions. That's right.
Yeah, well,
right.
Yeah,
exactly.
To your point, though, in small business, you're probably never going to make it up on volume.
Almost very unlikely, correct.
Right, very unlikely. And I think I hear this a lot in intro conversations with business owners, and we'll jump on a phone and I'll ask them about their business, and I'll say, I looked at your website and it looks like you do this, and I know a couple other organizations do something similar. Can you tell me what makes you different? And a lot of times the words that they share at that point tell me exactly how they think about it, right? They might say, well, yeah, we do that, but we do it cheaper, or we do that, but we also do this other thing with it. And that's really like a bundling product, right? Or, our clients stick with us forever because they can't find a better deal. Well, that works so long as you remain in business, because if you're not in business, you're not helping or serving anyone. So we're just going to leave that one there. Last question from the audience. We got Jessica Wen, COO of Smart Commerce, says, we've expanded into new markets. Our gross margin has dropped precipitously. How do we fix this? Phil?
Raise your prices. No, I mean, I think it starts with understanding the catalyst of what diluted your margins. So it sounds like whatever you did by virtue of expanding into these new markets, what diluted them. So at least you have the starting of the data to be able to analyze, where is this bleed coming from, right? And I think that would then reverse engineer is like, what are you unable to do in your flagship market are able to do in your new market that you are able to do in the flagship market that, is diluting these margins, right? Is it more expensive? Are the people to hire more expensive, right? Are the materials higher? I think really understanding these variables will dictate whether or not those are markets you should stay in, or ultimately, if you're looking for, continued expansion, it'll give you, some more tea leaves to look for to make better decisions that won't, you won't be surprised by being less profitable as a result of operating in a different place, right?
All right. Well, with that being said, we hope that our audience out there today has gained some clarity on what gross margins really mean for their business. You've learned hopefully some real world strategies from a CFO and an analyst on how to optimize for profitability. And, for those that chimed in, hopefully you got some answers to your biggest financial strategy questions in real time. So with that being said, as much as we enjoy spending our time with you, we want to thank you for participating. I want to thank my teammates, Phil and Augie, for joining. I want to encourage you out there to join our newsletter, Finance in 5, for weekly financial tips, updates, and Q&A from this episode. And we look forward to seeing you next week at 3 p.m. We're going to be covering revenue targets and the CFO's role. And we hope in that session, just like every session, that we can help you gain financial clarity live. Thank you. Have a great day.